everyone, welcome back to Mindful Investing. Duolingo just had a massive week in the markets. The stock is down nearly 26% after earnings and around 42% year to date. And if you are holding shares like me, you're probably wondering what just happened because at first glance, the Q3 numbers looked great. So, in this video, let's break down exactly what's in that earnings report, what caused the sharp sell off, what's actually going right for Duolingo, the key risks ahead, and most importantly, whether this pullback is a buying opportunity or a warning sign. And I'll also share my personal take since I already own shares and recently added more around $200. So let's get right into it. Duolingo reported revenue of $271.7 million, dollars, which was up 41% year over year. That's incredibly strong growth for a company that's already over $1 billion in annual revenue run rate. Bookings came in at $281.9 million, dollars, up 33%, and adjusted EBITDA hit $80 million dollars with margins expanding to 29.5%. And on top of that, the business is scaling efficiently. Free cash flow hit $77.4 million, dollars, up 51% year over year, and margins remain strong at 28.5%. From a headline perspective, this quarter looked like another win, but the stock still fell 26%. And the main reason was the guidance. The stock market doesn't really trade on what's already happened, it trades on what's coming next. Investors always price in the future and not the past. So here's the real story. For Q4, management guided revenue between $273 million and $277 million, representing growth of 30 to 32%. Still solid, but bookings are expected to grow only 21 to 23%, which is a notable slowdown from the 30% we have seen in the recent quarters. And if you read their shareholder letter carefully, they have also mentioned they are prioritizing teaching quality and user growth over short term monetization. That one sentence pretty much explains the sell off. Wall Street wanted Duolingo to keep showing acceleration, but the company is choosing to slow down on monetization to strengthen its long term user base and product quality. So, in short, this is not a broken business story, it's a mismatch between investor expectations and management priorities. Now, let's talk about what's actually working for Duolingo. Duolingo's user base is exploding. Daily active users came in at 50.5 million, up 36% year over year. Monthly active users are now at 135.3 million, up 20%, and paid subscribers are 11.5 million, up 34%. Those are phenomenal numbers. To give you some perspective, that's more users than Netflix had in its first decade. And it's not just growth, revenue quality is improving too. Subscription revenue hit 229.5 million, up 46% year over year, with average revenue per user up 7%. So, operationally, everything is moving in the right direction. One of the reasons I stay confident in Duolingo is their financial strength. They ended the quarter with $1.12 billion in cash and short term investments and virtually no debt other than lease obligations. That's a fortress balance sheet. They're completely self funded, profitable, and generating nearly $500 million a year in free cash flow at their current run rate. So, while many ad tech and ed tech players are still burning cash, Duolingo is the rare one that's doing the opposite, growing fast and staying profitable. So, the only concern was the bookings growth, which is expected to grow only 21 to 23% compared to 30% growth we have seen in the recent quarters. Now, just to clarify, bookings represent the total value of all sales made during the period, including subscriptions that may extend into future months. It's basically a measure of how much new business Duolingo is locking in, even if that revenue hasn't been fully recognized yet. So, when bookings growth slows, it means the pace of new subscriptions and renewals is cooling off a bit, even though current revenue still looks great. That's exactly what made investors nervous. They see it as an early sign that growth might be leveling out. And if you read their shareholder letter carefully, management clearly said they are prioritizing teaching quality and user growth over short term monetization. That one sentence pretty much explains the sell off. Wall Street wanted Duolingo to keep pushing monetization aggressively, but the company is intentionally easing up, choosing instead to focus on improving the product experience, retention, and long term engagement. So, in short, this is not a broken business story, It's a mismatch between investor expectations and management priorities. The business is doing fine. Management just isn't playing the same short term game the market is expecting. Moreover, Duolingo is investing heavily in AI driven learning experiences. Their goal is to make digital learning as effective as having a personal tutor. They have launched new tools like Duolingo Max, integrated AI guided lessons, and new subject areas like math and chess, which, by the way, is already their fastest growing course. They're also expanding brand awareness globally. For example, their partnership with Lookin Coffee in Asia sold 10 million Duolingo branded drinks in just 2 weeks. That's massive reach, and it shows how much potential this brand has outside of language learning. Alright, so where do I stand on Duolingo after this 26% drop? Well, as I mentioned, I already own shares and bought more at around $200, and I'm currently down about 37%. Duolingo's fundamentals are solid: 41% revenue growth, 36% daily active users growth, expanding free cash flow, zero debt, and a clear long term strategy. Technically, the stock is now below its 200-day EMA on the daily and weekly charts. The next support level I see is around $144. I don't expect it to go that far, but I'll be prepared to buy in chunks if it does. And honestly, this reminds me of what Jeff Bezos once said about Amazon. Amazon stock went from $100 to $6 even while every part of the business was working beautifully. That quote captures exactly how I feel about Duolingo right now. The stock might be down, but the business underneath is healthier than ever. So, to sum it up, Duolingo's Q3 was a strong operational quarter overshadowed by conservative guidance. This isn't a story of collapsing fundamentals, it's a story of managing long term growth expectations. The company is profitable, expanding its user base, and doubling down on AI innovation, all while maintaining a debt free balance sheet. If you are investing with a 3 to 5 year horizon, this dip could actually turn out to be a great entry point. So, what do you think? Do you see this as a buying opportunity, or are you staying cautious until growth reaccelerates? Drop your thoughts in the comments below. I always learn and enjoy hearing your views. If you found this breakdown helpful, make sure to like the video, subscribe to the channel, and check out the spreadsheet linked below. You'll see my updated Duolingo prices along with all the stocks I've covered so far. Thanks for watching. Stay patient, stay rational, and as always, keep investing mindfully. I'll see you in the next one.